Welcome back to Boni's Life, the channel where we decode the complex world of finance, cut through the noise, and find the signal. I'm your host, Boni, and today we have an absolute blockbuster of an episode. If you've been watching the crypto markets over the past 72 hours, and especially the last 24, you know we are standing at a critical juncture. We are talking about Bitcoin battling the stubborn $82,000 resistance, Ethereum struggling to find its footing, and global macroeconomic shockwaves that are rewriting the rules of the game as we speak. Before we dive deep into the charts, the on-chain data, and the geopolitical chessboard, make sure you hit that subscribe button, smash the like button to feed the YouTube algorithm, and ring the notification bell so you never miss an update. We have a lot of ground to cover today, and I promise you by the end of this episode, you will have a clearer, more multidimensional understanding of where this market is heading than 99% of traders out there. Let's get into it. Before we get into the charts, I want to take a moment to reflect on the psychology of the current market. Trading is not just about numbers. It is about human behavior, fear, greed, and the collective anticipation of the future. Right now, the crypto fear and greed index is sitting at 42, squarely in the fear zone. Just a month ago, we were in extreme fear at 21. This shift from extreme fear to moderate fear is a critical transition phase. It indicates that the weak hands have been shaken out, the over-leveraged positions have been liquidated, and the market is now in the hands of the strong, the patient, and the institutional. When the masses are fearful, the intelligent investor is analytical. We do not panic, we prepare. Let's start with the elephant in the room, the macroeconomic landscape. Over the past 72 hours, the global economy has thrown a series of curveballs that have directly impacted the crypto markets. The most significant of these was the release of the U.S. Consumer Price Index, or CPI, data for April 2026. The numbers came in hot. Prices rose 0.6% on a monthly basis, driving the annual inflation rate to 3.8%. This is the highest level we've seen since May 2023. But why did this happen? The answer lies in geopolitics. The ongoing conflict in Iran has severely disrupted Middle Eastern oil supplies, causing energy prices to spike by 3.8% in April alone and a staggering 17.9% year over year. This energy shock has cascaded through the global economy, pushing inflation higher and forcing the Federal Reserve into a very tight corner. Following the CPI data, the Producer Price Index, or PPI, also surged to 6%, well above forecasts. What does this mean for crypto? It means the dream of imminent interest rate cuts is fading fast. According to the CME FedWatch tool, the probability of a Federal Reserve rate cut by June 2026 has plummeted to a mere 2.4%. In fact, markets are now pricing in a nearly 98% chance of no cut by June. And the odds of a rate hike are actually rising, currently sitting at around 25.1% for a 25 basis point increase. This higher for longer interest rate environment traditionally puts pressure on risk assets, including Bitcoin. Yet despite this massive macroeconomic headwind, Bitcoin has shown remarkable resilience. Over the past 3 days, Bitcoin has been locked in a fierce battle. On Saturday, May 10th, we saw BTC briefly top $82,000 on improving macro conditions before the inflation reality set in. By Sunday, it was trading around $81,224. However, as the hot CPI and PPI data hit the wires, Bitcoin dipped below the $80,000 mark, opening Wednesday at $80,473. As of right now, we are seeing Bitcoin consolidate near the $80,550 level. It is a staring contest between exhausted bulls and opportunistic bears. Let's break down the technical analysis because the charts are telling a fascinating story. Despite the rejection at the $82,000 to $82,800 resistance zone, Bitcoin is printing higher lows since its April bottom of around $70,480. This is a classic sign of underlying strength. Buyers are consistently stepping in to defend pullbacks into the upper $70,000 region. However, the short-term momentum is cooling. Looking at the 4-hour chart, Bitcoin is trapped in a tightening consolidation range between $80,300 support and $81,500 resistance. We are seeing a sequence of lower highs, which hints at short-term distribution. The oscillator readings are painting a mostly neutral picture. The Relative Strength Index, or RSI, is sitting at 60, and the stochastic is at 76. Both reflect balanced momentum conditions, neither overbought nor oversold. The MACD, however, is leaning slightly negative, highlighting fading short-term momentum underneath the broader bullish structure. So, what are the key levels to watch? For the bulls, a confirmed high-volume breakout above $81,500 is crucial. This would reopen the path toward the $82,400 to $84,000 targets. For the bears, a failure to defend the $80,300 level could accelerate downside pressure toward $79,500, and a breakdown below $79,000 could expose the market to a broader retracement toward the upper $77,000 range. It's a tightrope walk, and the next 24 hours will be critical, but technicals only tell half the story. We must look at the fundamentals and on-chain data to understand the true market dynamics. And here is where things get really interesting. According to a recent Bitfinex Alpha report, the current Bitcoin rally is being driven by aggressive spot demand, not just derivatives speculation. Spot cumulative volume delta, or CVD, rose sharply after May 8th, showing buyers absorbing supply at premium levels. Even more compelling is the behavior of conviction buyers, entities that accumulate BTC and rarely sell. These long-term holders have increased their stash to roughly 4 million BTC, marking their largest accumulation surge since the COVID-19 crash in 2020. Historically, this kind of aggressive accumulation by smart money precedes major price recoveries. They are buying the dip, anticipating a massive move upward. To truly grasp the magnitude of what is happening, we must look beyond the daily candles and understand the structural shifts in global finance. The traditional financial system, built on fiat currency and centralized control, is showing severe signs of strain. The aggressive money printing of the past decade has led to the sticky inflation we are seeing today. Bitcoin was born out of the 2008 financial crisis as an antidote to this exact scenario. It is a decentralized, hard-capped asset that cannot be debased by a central bank. As inflation erodes the purchasing power of fiat currencies, institutional capital is increasingly recognizing Bitcoin not just as a speculative tech stock, but as a pristine reserve asset. This is a paradigm shift. We are moving from the early adopter phase to the institutional sovereign phase of Bitcoin's monetization. This brings us to the insights of some of the most respected minds in the industry. Arthur Hayes, the co-founder of BitMEX, recently published a profound analysis. He predicts that Bitcoin will not only break the $90,000 barrier, but will explode past it to reclaim its all-time high of $126,000. Hayes argues that a break above $90,000 will trigger a massive short squeeze, forcing call option sellers to buy Bitcoin to cover their positions. But Hayes' thesis goes much deeper than market mechanics. He points to the global AI arms race and wartime liquidity as the true catalyst. Both the US and China are printing money aggressively to fund AI infrastructure, viewing machine intelligence as a matter of national survival. Furthermore, the conflict in Iran has exposed vulnerabilities in global supply chains, prompting sovereign nations to stop recycling surpluses into US treasuries and instead spend capital on defense and commodities. This flood of global liquidity, Hayes argues, will inevitably find its way into hard assets like Bitcoin. Furthermore, we must consider the impact of the upcoming US elections and the broader geopolitical instability. Historically, election years introduce a high degree of volatility as markets attempt to price in different regulatory and economic regimes. However, Bitcoin has proven to be remarkably resilient to political shifts, acting as a non-sovereign safe haven. The increasing polarization in global politics only strengthens the use case for a neutral, borderless settlement network. When trust in institutions declines, trust in mathematics and cryptography rises. This is the fundamental tailwind, driving the crypto market over the long term. Speaking of US-China relations, we cannot ignore the monumental Trump-Xi summit that just wrapped up in Beijing. While the word crypto was reportedly never mentioned, the implications for our industry are massive. The talks centered on US export curbs on advanced AI semiconductors, specifically NVIDIA's H100 chips, and the extension of trade truces covering critical minerals. Why does this matter for crypto? Because these critical minerals and advanced chips are the lifeblood of the crypto mining industry. US restrictions have severely squeezed Chinese mining operations. If this summit leads to a thaw in chip export policies, Chinese miners could regain access to top-tier hardware. This would redistribute the global hash rate and significantly impact mining profitability for operators in North America and Europe. The market knows this, which is why we saw AI-adjacent tokens like FET jump 4.1% during the summit. Let's also touch upon the derivatives market, which often acts as the tail wagging the dog in crypto. Over the past week, we have seen a significant flush out of open interest in the futures market. This means that the excessive leverage that often leads to violent, cascading liquidations has been cleared out. A market with lower leverage is a healthier market. It means that the current price action is being driven more by spot buying, actual accumulation of the underlying asset, rather than speculative bets on borrowed money. This aligns perfectly with the Bitfinex data showing aggressive spot demand. When spot leads and derivatives follow, the foundation of the rally is solid. While Bitcoin is holding its ground, the story for Ethereum is slightly different. ETH opened Wednesday at $2,274, down 2.8% from the previous day. It is currently the only top 10 cryptocurrency in negative territory this week. Despite the recent Pectra upgrade and strong ETF inflows, Ethereum is struggling to maintain momentum, testing support near its 50-day moving average at $2,240. However, we shouldn't count Ethereum out just yet. Institutional adoption is quietly building. We are seeing structural indicators of long-term institutional demand, and Wall Street giants like Charles Schwab have just rolled out Bitcoin and Ethereum trading for selected retail clients. The institutional pipes are being laid, even if the price action is currently lagging. Meanwhile, the Solana ecosystem continues to innovate at breakneck speed. The recent Alpine consensus upgrade in testing has cut transaction finality from 12.8 seconds to under 150 milliseconds. This is a 100 times improvement that could solidify Solana's position as the premier blockchain for high-frequency DeFi and decentralized applications. With mainnet deployment targeted for Q3 2026, Solana is a network you must keep on your radar. Let's pivot for a moment to the broader decentralized finance or DeFi landscape. While the headline numbers often focus on Bitcoin and Ethereum, the real innovation is happening in the trenches of DeFi protocols. We are seeing a resurgence in total value locked TVL across various chains, driven by real yield generation rather than unsustainable token emissions. Protocols are maturing, focusing on sustainable revenue models, real-world asset integration, and improved user experiences. The days of yield farming, purely for inflationary governance tokens, are fading, replaced by a more robust, financially sound DeFi ecosystem. This maturation is crucial for attracting the next wave of institutional capital, which demands security, transparency, and sustainable returns. Another massive development flying under the radar is the explosion of tokenized US Treasuries. The total value locked in tokenized treasuries has just hit a record $15.35 billion. As inflation remains sticky and Fed rate hike concerns build, traders are seeking yield on-chain. BlackRock's Boydell Fund just reached $1 billion in assets under management, becoming the first tokenized money market fund to hit this milestone. JP Morgan is also filing to launch a new tokenized fund based on an existing $7 billion money market fund. Traditional finance is aggressively moving on-chain, and this convergence will bring trillions of dollars of liquidity into the crypto ecosystem. But we also need to talk about the regulatory landscape, because a massive shift is underway in the United States. The Senate Banking Committee has just released a 309-page draft of the Clarity Act, a landmark crypto regulation bill. This legislation would allow crypto companies to raise up to $50 million annually and up to $200 million in total without registering with the SEC. This is a game changer. It provides the regulatory clarity that developers and institutions have been begging for. While SEC Chair Paul Atkins insists his agency can regulate crypto without the bill, the momentum in Congress suggests that a new era of digital asset regulation is imminent. This clarity will unlock a wave of innovation and investment that has been sitting on the sidelines due to regulatory fear. It is also imperative to discuss the role of stablecoins in this ecosystem. Stablecoins have become the de facto reserve currency of the crypto market, providing the liquidity and stability necessary for trading and DeFi operations. The total market capitalization of stablecoins continues to grow, indicating fresh capital entering the space. Moreover, the regulatory scrutiny on stablecoins is forcing the industry to adopt higher standards of transparency and backing, which ultimately builds trust. As stablecoins become more integrated with traditional payment rails, they will serve as the primary bridge between fiat and crypto, facilitating seamless capital flows and driving further adoption. Finally, let's look at the broader tech sector's pivot to AI and how it intersects with crypto. Coinbase recently announced a 14% workforce reduction, cutting 700 jobs as part of an AI-native restructuring. CEO Brian Armstrong is leading this pivot, aiming to streamline operations and integrate AI deeply into the exchange's infrastructure. This is part of a sector-wide trend where tech and crypto firms are leveraging AI to increase efficiency. The intersection of AI and blockchain is the most exciting frontier in technology today, and companies that master both will dominate the next decade. Before we conclude with our trading strategy, I want to emphasize the importance of continuous education in this space. The crypto market evolves at a breakneck pace. What was true 6 months ago may be obsolete today. To succeed, you must be a lifelong learner. You must understand not just technical analysis, but macroeconomics, cryptography, game theory, and behavioral psychology. This is why we do what we do here at Boni's Life. We aim to provide you with the multidimensional intelligence required to navigate this complex landscape. Do not rely on single indicators or hype. Build a comprehensive thesis based on rigorous research and critical thinking. Let's delve deeper into the concept of tokenized real-world assets, or RWAs. This is not just a buzzword. It is the bridge that will connect the $100 trillion traditional finance system to the blockchain. When we talk about tokenized treasuries hitting $15 billion, we are witnessing the tip of the iceberg. Imagine a world where real estate, private equity, carbon credits, and even intellectual property are tokenized and traded 24/7 on global permissionless ledgers. This brings unprecedented liquidity, fractional ownership, and transparency to historically illiquid and opaque markets. The institutions are not just buying Bitcoin. They are rebuilding the plumbing of global finance on blockchain rails. This is why the infrastructure plays, the layer 1 blockchains, the oracles, the identity solutions are so critical to watch. Furthermore, the intersection of AI and crypto goes beyond just tech companies restructuring. We are entering an era of AI agents interacting directly with smart contracts. Imagine an AI agent that manages your portfolio, automatically seeking out the best yields across different DeFi protocols, executing trades based on complex algorithmic strategies, and rebalancing your assets in real time. This requires a financial system that is programmable, deterministic, and accessible via APIs, exactly what crypto provides. The synergy between AI's analytical power and crypto's execution layer will create financial products and services that we cannot even fully conceptualize today. This is the frontier, and it is expanding rapidly. Let's also analyze the mining sector's evolution. The upcoming Bitcoin halving cycles will continue to squeeze miner margins, forcing the industry to become hyper-efficient. We are seeing a massive shift towards renewable energy and grid stabilization. Miners are no longer just consumers of energy. They are becoming essential partners for energy producers, acting as flexible load resources that can absorb excess power and shut down during peak demand. This symbiotic relationship is transforming the narrative around Bitcoin's environmental impact. As the mining industry matures and integrates with the global energy grid, it solidifies Bitcoin's physical footprint and political resilience. In the context of the Clarity Act and US regulation, we must also observe the global regulatory arbitrage taking place. Jurisdictions like the UAE, Hong Kong, Singapore, and the EU have been aggressively establishing clear, comprehensive regulatory frameworks to attract crypto businesses. Capital and talent flow to where they are treated best. If the US fails to provide clarity, it risks losing its leadership position in the next major technological revolution. The Clarity Act is a crucial step, but the global race for crypto dominance is already well underway. This geopolitical competition ensures that crypto cannot be banned globally. It can only be embraced or lost to competitors. Let's return to the immediate price action and the psychology of the retail investor. During periods of consolidation like we are seeing now, retail interest often wanes. The mainstream media stops covering crypto, and the tourists leave the market. This is precisely the time when the smart money accumulates. They buy the bottom. They understand that markets move in cycles of expansion and contraction. The current contraction in volatility is a coiled spring. When the macro environment shifts, perhaps when the Fed finally signals a pivot, or when a major geopolitical event forces a flight to hard assets, that spring will release. The key is to be positioned before the move, not chasing it after it happens. Therefore, risk management is paramount. In a market capable of 20% swings in a matter of days, position sizing and leverage control are your best defenses. Never risk more than you can afford to lose on a single trade. Use stop losses to protect your capital and take profits on the way up to secure your gains. The goal is not to catch every single top and bottom, but to capture the meat of the trend while preserving your capital for the next opportunity. Survival is the first rule of trading. Profitability is the second. As we look ahead to the rest of 2026, the confluence of factors is unprecedented. We have a maturing asset class, massive institutional infrastructure being deployed, a shifting macroeconomic paradigm, and technological breakthroughs in AI and scaling. The volatility will undoubtedly continue, but the long-term trajectory remains clear. We are witnessing the financialization of the digital world, and Bitcoin is the pristine collateral at the center of it all. So, how do we synthesize all this information into an actionable strategy? We are in a market characterized by high macroeconomic anxiety but strong underlying fundamental accumulation. The Fear and Greed Index is currently sitting at 42, indicating fear. The market is cautious, digesting the hot inflation data and the fading hopes of rate cuts. However, the aggressive spot buying by conviction holders and the massive institutional infrastructure being built, like tokenized Treasuries and the Clarity Act, tell a bullish long-term story. For the next 24 to 72 hours, my strategy is patience and precision. I am watching the $80,300 support level on Bitcoin like a hawk. If it holds and we see a volume-backed push above $81,500, that is a clear long signal targeting $83,000 and beyond. If we break below $79,000, I will be looking for accumulation opportunities in the $77,000 range, because the smart money is buying those dips. For Ethereum, I am waiting for a confirmed bounce off the $2,240 support before considering new entries. And I am keeping a very close eye on AI-related tokens and the Solana ecosystem, as they are showing relative strength and massive technological progress. Remember, in markets like this, volatility is not your enemy, it is your opportunity. But you must approach it with intelligence, discipline, and a multidimensional understanding of the forces at play. Do not get shaken out by short-term noise. Look at the macro trends, follow the smart money, and always manage your risk. That is all for today's deep dive on Boni's life. I hope this analysis has provided you with the clarity and intelligence you need to navigate these turbulent waters. If you found value in this episode, please share it with your fellow traders. Leave a comment below with your thoughts on Arthur Hayes' $126,000 prediction, and don't forget to subscribe. Until next time, stay sharp, stay disciplined, and keep finding the signal in the noise. I'm Boni, signing off.